So once again, everyone, welcome to day 3 of Trading Alchemy. And today we'll be talking about entries and exits. Now, also be mindful. I know this might seem soon as well. Let me just make sure I am recording this. Okay, there we go. Yes, like I said, don't get overwhelmed over what you might see. Like I said, I'm just trying to put all these concepts through to you guys. And then literally as we move along, so I would say from next month on day 5, we're actually going to go deeper into zone refinements, beta entries, and all other questions you guys also might have. So basically, we'll go much more deeper into detail as time goes on. Okay, so then Christopher also says, still going through the first and second video, really want to grasp across the concept. But awesome, man, awesome. Liquidity, like I always say, if you can't spot liquidity, you will become the liquidity. So let's get into it. So first things first, once again, as you guys know, I have to do this. A disclaimer, trading does involve risk. Vault Markets is a licensed broker. And all the views shared in this video basically is all my personal opinions and what has helped me become profitable as a trader. So we are all adults here. We all make our own. We all make our own responsible decisions. So yeah, let's get into it. So today we're going to be talking about cause and effect. And basically with every cause, there is an effect, and every effect has a cause. So the law states that every effect has a cause and every cause has an effect, like I just said. Everything happens in accordance to the law, and there is no such thing as chance, meaning there's no such thing as luck. Everything happens for a reason. I always say luck is just preparation and timing meeting at the right time. So the principle underscores the notion that the market movements are not random, but instead driven by a sequence of cause and effect relationships, which cover this, the composite man, inducing individuals, fundamentals, things like that. Okay. Now, the importance of entries and exits make a massive, massive difference in your trading. So the first thing is precise entries and exit points are pivotal in cause and effect trading because they directly influence the effectiveness of your trading strategies and the overall profitability of trades. Meaning, if you have a bad entry on a trade, you might not, or you will not experience that full potential of that trade, basically. And another thing is, for instance, spread. Your spread can also have a massive effect on how you're going to draw down or into profit. Okay, so then precise entry points allow traders to enter trades at sorry. So precise entry points allows traders to enter at opportunistic movements, moments when the probability of success is the highest. Meaning as well, there's a lot of things that must fall into place before you actually take a trade. Meaning your confluence, for instance. So these exact points or levels in the market is where your exact entry should be. For instance, if you think about it in a sense of how a spike is formed, that spike touches a level at a high or a low before it pulls away from that zone. And if you can enter on that zone, that means you will automatically be trapped into profit instead of being trapped into a loss. So by identifying strategic entry-based levels on using your market analysis and technical indicators, you can then minimize your risk and maximize your potential profits. And similarly, well-timed exits enable traders to actually lock in your profits or cut losses before movements go against you. And this also goes back to some psychology. My mentor has taught me this. The moment you have a thought to move your stop loss, let's say you enter a trade and you're going to draw down, and you feel like I have to move my stop further away from entry. Or if let's say you're in profit and you want to move your take profit further away to make more profit, the moment you have a thought where your mind tells you to move your stop or take profit, cut the trade because you've given into greed. So these exits as well, always learn to take your profit, because if you don't take your profit and market reverses, I always say it's better to walk away with a little money that you've made than to regret a dumb decision that you've made, if that makes sense. So entry and exit decisions with market dynamics. So understanding market dynamics is essential for making informed entry and exit decision. And this goes back to understanding a market structure as a whole. So we'll cover this later on, but meaning you should understand structure as a whole from a higher to a lower time frame and put this puzzle together, basically. So traders must analyze various factors, including economic data releases, geopolitical events, and market sentiments in order to anticipate certain market movements. So what this means is, as a trader, you must always be informed with the right information. If I can give you an example of this, massive companies like BlackRock, Vanguard, Citigroup, Point 42, they literally employ people to just attend meetings and provide them with information, meaning information is power. There's also a quote on this: money and information controls a nation. Whoever controls one controls both. So what's the consolation? Okay, so market structure becomes your best friend for understanding where price will head. And also by understanding market structure, if you are in a trade, you can potentially identify if the market is about to go against you. And that's also the beauty of retracements. Because even though a retracement, when you're in profit, you don't want to see a market retracing. But if you're in profit, for instance, and you can see a change of character take place, it must form a pullback. So instead of then getting out of the trade when it has pulled back a bit, you can wait for that retracement and then also still maximize how you get out of that trade instead of cutting the trade at a lower level, basically. Does that make sense? I hope it makes sense. Okay. Then the key components of alchemical entries and exits is basically consists of three things: your technical analysis, fundamental analysis, and as well as your risk management. So technical analysis, as you guys know, this is basics, but I'm also just putting us in there for the people who maybe might not know this. So technical analysis involves the study of historical price, data, and market behavior, meaning when you take a trade based on stats and data and not your emotions. So advanced technical analysis techniques enable traders to anticipate market trends. And this goes back to being able to identify what's going to happen while you're in a trade. And this also goes back to anticipation. If you backtest enough and you study the market enough, you have a certain idea as to how the market must move before you go into profit or while you are in profit. So that anticipation should also allow you to get out of the market. Well, let me put it this way. If your backtesting, for instance, states that within 30 minutes you should be in profit, if an hour goes by not in profit, that means that your stats now shows you that it's time to cut the trade, basically, you know? Now, the key components of technical analysis include trend analysis, meaning identifying the direction of the market trend and trading in alignment with the prevailing trend, meaning understanding your higher highs, higher lows, lower highs, the basic things that make such a massive difference in your trading. Then also support and resistance levels. So identifying key price levels where buying or selling pressure is likely to emerge, and as well as indicators. Now, I'm not one to condone indicators or recommend everyone use indicators, because indicators are also backed on data, previous data, but an indicator cannot make a decision like a human, you know, so indicators sometimes lag, right? So if you can set up your indicator with the right stats or the right settings, then you will obviously be able to take advantage of that. And this goes back to as well backtesting that indicator to make sure that it provides you with the correct information. Let me know if I'm going too fast, hey guys. Do let me know. Then also fundamental analysis. Fundamental analysis focuses on evaluating the underlying economic factors and market conditions that influence asset prices, meaning monetary statement, unemployment, consumer price index, GDP, interest, you know, all these type of things. So like I just said over there, fundamental factors such as economic indicators, central bank policies, geopolitical events, market sentiment can impact entry and exit decisions. So you always want to be informed, like I said, because the last thing you want, for instance, is also when you're in a trade and suddenly the market spikes against you and you can't explain why. Here's the thing. As a trader, you should always be able to understand why certain things happen. Meaning, for instance, if you are in a trade and you know that there's a certain news event coming out, you know, move your stop to break even. Know how to manage your risk, basically. Then also, traders can also analyze economic data releases, central bank announcements, or geopolitical developments to gauge the health of economies and anticipate market movements. A very good example of this, for example, is BRICS, and how BRICS is changing the landscape of how economies will eventually operate within countries. And then we also have, last but not least, risk management, which makes a massive difference also as to how your trades will affect your overall account balances and history. Then risk management is a critical aspect of your trading, which aims to preserve your capital and maximize your profit while controlling losses. So I read something this weekend, which is very, very interesting, where it said, don't let your profits go to your head, and don't let your losing trades go to your heart. I always say this to you guys on stream, in these videos. Trading is a business, so always see it as income and expenses. So any business that operates must have more income than expenses in order to be profitable. And also, if a business has an expense, they don't complain or take it to heart if they have to pay that. So same thing with your risk management. So if you take a loss, it should be controlled, and it should be something that you're willing to take based on a calculated decision. So effective risk management strategies help traders navigate volatile market conditions and maintain a disciplined approach towards trading. So for instance, as well, if your trading plan states that you can take, for instance, 5 losses with a risk reward of 1 to 5, or you can take 5 losses and make it back in one trade. That means that because your system is so highly set up, when you have a moment like that, you can always refer to your trading plan, and that becomes your backbone to always understand that, okay, just because you took a loss now doesn't mean it's affecting your overall trading. Does it make sense? So the key components of risk management, sorry, not technical analysis, of risk management include position sizing, meaning your lot size. You have to be able to determine the appropriate size for each trade based on your risk tolerance and your account size, meaning you can't trade a $10 account and want to put down 100 lots. Your account won't even survive the entry. Luke, all good, man, all good. This will be recorded and be added to our YouTube. That's always. And like I said, this will be a series that I want to continue for the rest of the year. Then also stop loss placement. So stop loss, I'm sure you guys know this, but like I said, just want to add this in there as well for everyone who might not know it. So your stop loss placement is to limit potential losses and protect your capital in case price moves against you. So for those of you guys who might not know this, a fun fact about your stop loss, you can actually move your stop loss into profit if you didn't know that. Let's say, for instance, you buy and market moves 20 pips into your favor. You can then move your stop loss literally 19 pips into profit. Understand my point? So this is also what is meant by a trailing stop, trailing your profits, trailing it with your stop loss. And then the last one is profit taking techniques, meaning implementing a take profit. Implementing a take profit is for you to secure your profit and exit your trades at predetermined targets. So for instance, I'm sure most of us here, we work jobs, we are busy, so we can't always look at our phones. But the beauty of a stop loss is it's like a safety belt. So if the market moves against you, it kicks you out of the trade automatically with your fixed risk. Same for take profit. It kicks you out of the trade automatically based on your target. So instead of you waiting for price to hit there and then closing it manually, it can automatically just kick you out of the trade and you'll have the money. Okay. Now, remember also last week we spoke about this. Just want to refresh your memory. Market structure, as you know, market does 3 things. It goes up, down, or it goes sideways. So if it goes up, it means bullish, down, bearish, sideways, market consolidates basically. And once again, as you know, in the uptrend, we have a high, a low, a higher high, higher low, higher high, higher low. Downtrend, low, high, lower, low, lower high, lower low, lower high, lower low. So market structure as a whole, this is how price might look, and this is why it's important for you to be able to spot when price or what the market, or able to, or how can I put it? That's why it's important for you to be able to read the language of the market, basically. So now, a lot of you guys might not know what this is. So what is a change of character or chalk? So a chalk basically is a change of character. It's just an abbreviation. So this CH stands for change, O of CH character. So change of character is what we call a chalk. So whenever you see it on my chart, don't be confused. And how change of character works basically is if the market is bullish, so you can see over here, market moves up, forms this high over here, pulls back, forms this low, then price initially moves up, taking out that high. That's what we call a break of structure. As you can see, price forms a higher high, forms that level where price basically finds resistance, pulls back into this level, holds support, and then basically breaks to the upside again, taking out those highs. Then moving forward, we have a break of structure once again, higher high, higher low. Now, here is the very important thing about changing character. You're literally just following the pattern. And this is why I see a lot of people make a mistake because they force their analysis. They force the market to do something it's not doing. So looking at what price is doing, if this is your last low price has left. Now remember characteristics of an uptrend. Let me just quickly go back to this just to put some emphasis on that. So emphasis on this. A high, a low, a higher high, higher low, higher high, higher low. That is a characteristic of an uptrend. And a low, high, lower low, lower high, that is a characteristic of a downtrend. Do you now understand where the terminology change of character takes place, right? Okay. So knowing that this is the last low price has left, when price takes out that low, this low over here is now called a lower low. And why? Simply because that low is lower than this low over here. And we know a lower low is part of a downtrend. So that is how you spot a change of character. And this goes back to what I meant by you should embrace retracements. So let's say, for instance, you enter a buy position over here and you go into profit, market pulls back, you go into profit, market pulls back. Now, let's say, for instance, in this moment, market pulls up, changes character. Now you know, oh, market's about to reverse. But now instead of cutting the trade over here, you could potentially wait for that retracement where price must reverse and exit at that position basically. So then instead of cutting your profit in half, for instance, like in this example, you can still maximize your profit based on what price has done. Does it make sense? Does it make sense to you guys? And same for a downtrend. So a downtrend, once again, you will look at the characteristics of a downtrend, meaning you will have a low, a high, lower low. Sorry. You will have a low, a high, a lower low, lower high, lower low, lower high, lower low. And once again, I'm just looking at the last lows and high price has formed because those highs and lows is where price will either find its support or resistance to to have a breakout, continue trend, or basically form a reversal. So in a downtrend, same thing. I just follow the trend, high, low, lower low, lower high, lower low, lower high. So I see over here, here's a lower high, and when price takes out that lower high, it forms a higher high. And as we know, a higher high is part of a uptrend. So in an uptrend, for instance, now we know price has changed character. Let's say, for instance, you took a sell from this level, price pulls back. You can still wait for price to potentially pull back into these lows and take profit over here potentially. So very, very simple. Now, why I'm mentioning this is because how I actually enter my trades when we go cover that, that is part of my checklist. A change of character, with a supply and demand zone, or a fair value gap. If I don't enter on a supply or demand zone, I want to enter from a fair value gap. Now, the question is, what is a fair value gap? So basically, a fair value gap is the relationship between three candles. A quick one in the chat. How many of you guys know what a fair value gap is? I just want to see something real quick. A fair value gap or an imbalance, whatever you want to call it. Okay, perfect. Now remember last week in day 2, we spoke about supply and demand and what makes a supply and demand zone valid. And we said we always want to see a imbalance. Now remember I also spoke about it that I see a difference between a fair value gap and an imbalance. For me, an imbalance is if you look at a big time frame like the 1 hour, 4 hour, 15-minute, daily, weekly, and you have this, what I basically will show you guys here now. On a big time frame like that, I consider it an imbalance because the amount of pips within that zone might be like 50 to 100 pips. So automatically from a economic standpoint, that is a massive difference in that economy. So price has to go balance it out. Understand my point? Now with a fair value gap, basically, with a fair value gap, is the name itself, it's fair value for your money. That's the way I perceive it. So I would only use a fair value gap on a 1 minute or a 3 minute time frame based on my entry. And why is that? Because I've noticed from my backtesting, a fair value gap is not always completely filled. This is why it is valid for you to enter from this, compared to an imbalance where price will most likely fill it completely and where you have to react from the supply or demand zone. Okay. So Christopher says never trade a fair value gap. So I don't understand the entire concept behind a fair value gap. Don't worry, Christopher. So what basically happens is it's just a fair value gap is formed with a displacement in price, meaning that candle moves so quickly, it shifts the market away from a certain level. Whereas, let's say, for instance, the market moves up. If you sold there, the market moves away from you so quickly that you don't even have time to put a tight stop loss, basically, if that makes sense. So what is it? So as you guys know, a candle will always have a body and it will always have a wick, right? Like I said, a fair value gap or an imbalance is the relationship between three candles. Notice over here, we have candle number 1, candle number 2, and candle number 3. Now notice candle number 1 has a wick on top over here and a wick at the bottom. Candle 2 has a wick on top, no bottom wick. Now, the reason why I've done it like this is because I'm very realistic about the market. It won't always look as beautiful as they portray it to be. We have to be realistic about this. So let's say no bottom wick, it's fine. Third candle, we can see a bottom wick, no third wick at that level. However, what's important about this is you will see basically the relationship between three candles. You'll always look at the middle candle, this one over here. So then you always look at the wicks next to it. So meaning on the left side, here is the left wick, here is the right wick. So you can see over here that the wicks basically, if you draw a line through them, that the wicks basically touch each other. So what I mean by that is, let's quickly imagine. Okay, so quickly forget about this candle over here. Forget about it. So let's say this candle over here forms, it moves up and closes. This candle opens over here, it moves up and closes. Now, technically, when this third candle, which I said you must forget, let's now focus on that. Now, this third candle opens over here at this level. Now, what happens is there's this wick down here, basically. Whereas if price hasn't come back to that wick yet, so there is an imbalance there, basically. So what will happen is that wick will always come back, touch it more or less, and that will balance each other out on the market. So if you look at the next example, you can see here's the first candle, price moves up, closes. Second candle forms, moves up, closes. Once again, forget about this candle over here because even real time, that won't exist yet. Look at the next candle. We can see now over here, a wick has formed. And now we can see on the third candle that this wick over here, this one over here, must now trade down in order to do something like this over here. Okay. But then what happens now is now we can see this candle closes, leaving a wick like this and a wick like this. Now notice over here how that touched, and notice how there's no touch within these wicks. And this is how this box is formed. This is what I call a fair value gap or an imbalance. Market is fractal. You can see it in all time frames. Then basically what I want to see is when I look for my entry, let's say on my 3 minute, 1 minute, I want to just see price come back into this fair value gap. Just tap it and you will see price basically run. Okay. Before I continue, just want to make sure from everyone now that you guys follow that, what I just said. Okay. Awesome. Awesome. And same thing for a downtrend or a bearish market, the same exact rule. You can see our candle basically, let me just change the color on this. We can see the market trades down candle closes, leaves us a bottom wick and a top wick. Forget about this candle over here because it doesn't exist yet. So the next candle forms, we can then see, okay, here's the wick. Candle forms and closes, moves down. So now we can see price must go full that basically before we can look to go short on this pair. Then we can see price fills it. So now technically it doesn't count. So that's no fair value gap. Next example, we can see price moves down, leaves us with the wick at the bottom, wick on top. Forget about the candle, doesn't exist yet. Then this candle comes, moves down, and now the third candle opens at this level. Now we can see the market moves up, it moves down. So remember, because a candle moves up and down, time frame hasn't closed yet, you wait for the candle to close. Because, okay, don't get confused here. Just because the candle is still open and it taps this level, it must still go close. So even though, for instance, over here at this level, when price moved up, it could have easily continued to the upside because there is no confirmation yet. So then on the third candle over here, which I said, forget about the last one over here, we can then see this candle closes, eventually no bottom wick, and here we have 1, 2, 3. Then we can see, okay, here's the top wick, here's the next wick. It hasn't touched, so that's our fair value gap basically. Okay, hope everyone followed that. So another thing, you have to also understand that there is structure within structure. So the market is fractal. So, okay, so the blue line on my chart right now is the 4-hour. Imagine it as a 4-hour time frame. So a 4-hour, you will maybe see price basically move to the upside, something like this. The price moves up, as a pullback, moves up, breaks structure, and then forms a new higher high on the 4-hour basically. All right. But now within that, if you go to the 15-minute chart, for instance, it won't look like that. You will see a much bigger pattern. You will see internal structure, right? So that's basically why I'm getting into this. What I mean by the puzzle you must put together. Please don't get confused what I'm explaining here basically. So let's say, for instance, you are looking at a 4-hour chart. You have a break of structure. Now your 4-hour demand is formed down here. Now be mindful that if when price moves down to this level on a smaller time frame, it's going to tap into that level, but it doesn't mean you must blindly enter the trade. You have to wait for some sort of confirmation, meaning internal structure. So when price comes back towards that level, price will be bearish, even though overall, long-term, bigger time frame, price is bullish. Internally, price will be bearish. So then once price taps your demand, you want to see price hold it. Once price holds it, basically, you want to see an internal change of character, meaning internally, you want to see price form a new demand zone. For instance, like at this level where we can see low, high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. Then we see higher high. We just discussed the higher high, characteristic of an uptrend. So with that said, that higher high will then leave you with the demand zone. All you wait for then is a pullback, and this is where you then potentially take your trade towards the upside. Okay, hope that makes sense as well. Let's move on to a bearish example. Same thing, 4-hour, the blue line, a 15-minute chart, the white line. You will always have internal structure within external structure. And let's say, for instance, price moves bearish on a 4-hour. So there you have it. Price pulls back. Price comes back to a level, break of structure, forms a lower low. Now we can see a price is bearish. Now, once again, here's your supply zone up here. So even though price is bearish all the way down here, it has to move up. But how? Internally, it has to be bullish. So we'll have a high, a low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, until we tap into the supply zone. Once we tap it, and once again, you don't enter blindly, you wait to see price holds it. This is the other thing. So you have to be patient with this. Now, I know you might think, look at this and be like, yo, Jevon, 4-hour chart. How am I going to wait so long? Once you understand structure completely, you can then do this on smaller time frames, like the 1 minute and the 3 minute. And then you can then base your 15-minute like your 4 hour and your 1 minute and 3 minute like your 15-minute. Okay. So then once again, you want to see price take out that low, meaning that lower high, forming a lower low because you are bearish. Lower low be formed, change of character, wait for that pullback, and this is where you potentially take your trade to continue the trend towards the downside. Okay, before I move forward on this, also just want to make sure from you guys, do you guys understand what I just said here regarding internal and external structure? If you do, just drop a 1 in the chat or say yes. Awesome, awesome. Great stuff. Love you guys, man. Okay, so then this is exactly what I'm explaining. So consider the blue lines over here, your external low and your external high. So consider this white line, your 4 hour, okay? Now remember, this is your external low, your external high. So internally, you will also have your highs and lows, basically. That's just a very, very simple concept. And once again, over here, downtrend, you have an external high, external low, internal highs and lows, meaning your internal structure. Okay. I feel like I haven't touched on this the first time we spoke about it. So this is your cheat sheet, your 15-minute cheat sheet. As you guys can see, you're looking at the bullish structure because you can see price is forming higher highs and higher lows. So you can see a high, pullback, higher high, higher low, higher high, higher low. Price pulls all the way back, higher high. Okay. Now, with this said, if you are bullish on a pair, remember day one, if you haven't watched it, go back and watch day one. If price breaks below your Asian box, you look for buys. If it breaks above your Asian box, you look for sells. So automatically, the best thing to do is if you are bullish, you want to see price break below the Asian box to confirm your buys. So meaning if you're an uptrend, this is your cheat sheet. You want to see, you want to basically see price form your Asian high and low. And because you're bullish, you want to see them take out the Asian lows, targeting the Asian highs, because you know that that will be your profit target. And this is a perfect example again of taking your profit. Because if you hold this trade overnight, remember the Asian lows will be untested tomorrow. They're gonna pull back and they're gonna test those lows. Exact same thing. So let's say for instance, you potentially took this position, you enter long at this level. You take profit at the Asian highs and the previous daily high. Tomorrow, the same thing. You start off clean, wait for your pullback, into your position, take profit at the highs and at the highs. Very, very simple. So I would say take a screenshot of this because it could definitely help you in the future. And then for a downtrend, a bearish, so this will be your bearish cheat sheet. Meaning if price is bearish, as you can see, price forming lows, low, high, lower, lower, high, lower, low, lower, high, lower, low. So if you are bearish, the best thing you want to see is price form your Asian lows, take out your Asian highs, tap in your supply zone, get your entry, and your target will be, and your potential target will be your Asian lows and yesterday's low, basically. An exact same thing. You take your profit, even though you might see this will happen and price run without you. I would rather miss out on pips than regret it. A good example of this is look at the example I made. And I've made this exactly because this is my experience. Whereas you hold that trade all the way, you don't close it, and tomorrow price comes back to your entry point. You know? So see ya, this session will be uploaded. All of these trading alchemy sessions will be uploaded every Monday, either during the afternoon or at night. I must obviously just make the edit where I must add a disclaimer for legal purposes, unfortunately. So I will have to edit that. I'll have to record this, convert it, and then upload it only. So tonight it will be on my YouTube, don't worry. Okay, so what is my entry criteria? There's a few questions I ask myself. And my system has a lot of rules to follow. And this is why I don't always have a trade every single day. But when I do have a trade, it's perfect because a lot of things are met and it's based on data. So the first thing I want to say is, as you guys know, the number one rule of trading is to buy low and sell high. Now where is low? The high. Now where is low? The low of the session, low of the day, low of the week, low of the month, low of the year, low of the quarter. Where is the high? High of the session, high of the day, high of the week, high of the month, high of the quarter, high of the year. So that highs and lows is your true support and resistance. So when I want to buy something, I always want to buy at the low of the day or sell at the high of the day. So also, I hope you guys are taking notes. It's not in here. And just also one thing, a lot of things I don't put in here, I would say it for you to take notes because only those things are available to my students per se. I'm actually giving you guys things from my mentorship as well. So what makes a high and low of the day valid? Market maker or the composite man must hold the high and low of the day for at least 90 minutes for it to become valid. So then another thing is I would ask myself, is it in an institutional level valid? Now we'll also talk about this in the future. There's also a video on my YouTube on institutional levels. Then do we sweep liquidity? Because if you can't spot liquidity, you become liquidity. And then do we have a change of character? Do we have did it leave a fair value gap in a displacement? Unfortunately, my man, I can't have you record the session. Only I can record it and only I can upload it. So then did it leave, so when you have a change of character, did it leave a clear displacement with a fair value gap? That's an important rule. Then when we are at the high and low of the day and all these things are met, are we at the supply or demand zone? Then when we came to the supply and demand zone, did we have any vector candles? Vector candles is taught in my mentorship. And then are we in London or New York session? Timing. Time and price must always meet like this. And then does my Fibonacci line up with my zones? So once all these things, there's more, I just haven't added them. But also it goes back to data, so if this, for instance, isn't met, so here's the thing about my course as well and my method. It's based on many things. So if the one, also see it this way, that the market isn't always in the same condition. So if the criteria for this condition isn't met, I have criteria for other conditions as well. Because like literally I've studied the market for more than 5 years now. So does my fib line up with my zones? That becomes part of your criteria basically. Now let's look at some examples. So this is how price will look. Let's say you're on your 4-hour chart. So once again, 4-hour, the blue line, white line is the 50-minute. So let's say your 4-hour forms a high, pulls back, holds your low, and forms your break of structure at this level, basically, and forms your higher high. Now you have to wait for price to basically trade back into the zone. And this also goes back to, okay, it's in the sound. Don't confuse yourself on what to say. If you truly understand structure, you can then take the trade to the downside to your demand zone and then potentially buy up as well because you understand structure so well. I wouldn't recommend it to a beginner. I would say master this. Once you've mastered it, move on to like being able to trade in any direction. My mentor always told me, never predict, react. Be so good in your analysis that doesn't matter what the market is doing, you can always react based on what price is doing. Okay, so this is what you want to see. You want to see price then basically pull back into your demand zone, and then you want to see a certain pattern occur before that zone becomes valid. And we just discussed that basically. We want to see internally then a change of character take place. For instance, something like this. Where on the internal side, you will then see from this level, for instance, here you can see price changes character. That pullback, when price forms a pullback, or when price rejects that level, there's most likely, there's most likely a supply zone at this level, where you then can potentially then take this trade towards the downside, targeting these levels over here. And once again, same thing, spot liquidity. So for instance, what would make this demand zone valid? There has to be some liquidity built up. So this would be considered a double top. And some traders might see some support or resistance from 1977 line up with this zone because it was 1977, but it's not backed on actual data. So this is why I say you want to be able to spot liquidity, otherwise you become liquidity. Then you would then, for instance, see when price steps into your demand, price will form a change of character. And here's the thing also, guys, once you understand structure, price has to form these retracements, so price won't move without you. And even if price does move without you, it will come back to that point. Even if it's not today, tomorrow, it will come back then next week, next month, next week, next month, next year. It will come back to that level and you will have reaction. I actually did a session with someone about 2 months ago, where we looked at euro yen, and price came to a zone two years later and still had the reaction which we expected. So the market is based on order flow. Understand order flow, and you'll set yourself apart from retail traders. So then you can then see you have a change of character that takes place, and same like here on top, price will then leave you with a new internal demand zone. So basically what happens is, because price comes down, you are now technically in a supply chain, but you want to see demand hold and you want to see new demand created in order to take out the supply chain, if that makes sense. So once again, let me know if that made sense, because if it doesn't, I'll have to cover it again. And same for a downtrend. Once again, blue line is your 4-hour, white line is your 15-minute chart, and you'll have your break of structure. Then you want to see price basically come back towards that level. And like I said, if you are advanced enough and you understand order flow, you can trade both ways. For instance, you would see then over here, your change of character will take place more or less somewhere around this level. And all of this over here will just be that price catering for pullback, where you can tap into the newly formed demand to that supply and then ride the move to the downside. So and here's the other thing also, what actually happens here. If you go and study order flow the way I do, you will then see that the way this happens, for instance, this over here, this over here, that technically people see this as support over here. So if price breaks below that support, people will sell at this level. That's the other thing, how they also induce, because once again, people be selling low and be buying high, you know. And once again, you want to see price basically move towards your supply zone. You want to see them respected. You want to still follow structure. If this is the last low price is left, price must come take out this low. And once you have that, basically, that's when you start waiting for your reaction, where you can potentially take this move towards the downside. So once again, here's a good example of how this would work. So you would see more or less over here. This is the structure. Price would move out. Here's your Asian range. So here you can see this is your Asian highs over here, which has now been taken out. So price breaks breaks above the box. That means you look for sells. Then your target would be basically taking out the Asian lows. Okay. And a very similar example would be for a bullish buy model where price would move. You want to see some sort of liquidity built up before you take your trade. If there's no liquidity built up, don't take the trade, because most likely then, if there's no liquidity built up, price will continue that trend to induce until they have enough liquidity. So see it as this way: the composite man will only move price in a given direction based if their targets are met. So if, let's say, for instance, they need to collect 20 billion worth of stop losses, but they only collect 18 billion, they're gonna get that 2 billion. They're gonna get it, even if it means they must create a spike, for instance, you know. So here's just some examples to show you guys, like trades I have taken. So you can see over here, here's my Asian range. Over here, there's my Asian range. Price has broken above the zone. That means I look for sells. So this gray line over here on top, this line over here, this box, that is my higher time frame supply. So which means I look for sells from that level. And you would also see that just before I took that sell, there was a nice liquidity buildup with some trend line action over here. That means a lot of people started selling from those levels, basically, which means we had stop losses up here, stops up here, and stops up here, and stops up here. This was also the previous day's high. Notice how they just pinned the previous day's high, and we had the reaction. Now, once again, this is a 15-minute chart. I am advanced as a trader. So I'm looking at the internal structure of the 15-minute for my potential trade. So you can see over here, it says change of character. So that is a 3-minute change of character or 1-minute change of character. I can't remember exactly. But just to show you how that played out, once I have that change of character, you guys would see if I refer back to what we did over here. Change of character, you also want to see price. Here's the sell model. There we have it. Here you can see price must always trade back into the supply zone before taking that sell. And as you can see, I pointed it out over here. Asian high is taken out. I want to see price move up into that wick and then basically move down. Another thing is also wick fills. Study wick fills. As you can see over there, price tapped it, went into profit, stop at break even, profit taken at the Asian lows, TP1 was hit, and all the way down here, TP2 at the next demand zone, basically. Next example, also Euro USD. Notice over here, all of this box, this blue box is my Asian range. Notice this high, here's the Asian high over here. And notice that, okay, you can't see the time now, but 9:30 more or less. Price has slightly pinned above the Asian highs. Then we had a change of character take place. Now, here's the thing, guys. If it takes long, it takes long. Don't force anything. Then when I finally got my change of character, all I had to do now is wait for price to basically tap into my supply zone. So over here, you can see this is where the supply zone was, right over here at this level. Waited for price to tap into that zone, and boom, there we had it. Supply zone, and then price basically tapped into that zone, and then we had our reaction we were looking for. And as you can see over here, TP1 was hit at the Asian lows. TP2 was at the New York lows, meaning the high of yesterday. Very similar once again. This is gold. So I have 3 examples on here. Asian lows was taken out. Then you can see basically, so this was around 8, 9 o'clock. So you can see over here, price has traded above. Let me grab my tool. So price broke below. Price has moved back above. Changed character over here. Now, what I wanted to see basically was price come back into this level and have a reaction. So as you can see over here on this candle, it's not straight. Let me just get a straight line. So right over here, you can see price tapped into my zone. Then from there, I think I took a trade here. I think I took a trade and I had a stop loss, right? But then the fact that price came back into the Asian range showed me that I'm not wrong. I just entered at the wrong time. My rules was met. My rules was met. I followed my criteria. I just hit a stop. Then the next setup brings itself based on structure. So price held. So internal change of character. I waited for price to form it and tap into that zone. And there you see, price tapped my zone and then I went to profit. You know, so structure is a very, very interesting thing. Yeah, that's the end of the session. A quick one. Any questions from you guys before we head to a live chart, just to show you more or less how this will also look on an actual chart itself? Any questions? No questions. No questions. Okay. So basically over here as well, I want you to look at the beginning of the year on GU. So as we can see, price is clearly in a bullish range. So as you can see, we had a 4-hour break of structure. So we were bullish on that. Then internally, we had a break of structure over here, where price formed this higher high. Now with that said, okay, awesome. Noted, Christopher. Noted. Then you can see this is the low price has left. Then what do we see? Price has taken out that low, right? So now automatically This is now a lower low. So when price retraces back to these levels, we can start looking for sells. So let's just quickly on this one, let's quickly map out a supply zone. So this is the supply which price has created. And also, like here's the other thing, literally we react zone to zone. So here's another supply zone price has left. So let's wait and see quickly. So now we can see market moves down. Let's just quickly move all the way to this level. So when price start rejecting over here. So here's the last demand price has left over here. Okay. Now let's just quickly come to this level. Now this was the beginning of the year, January. So this doesn't really count. So I wouldn't want to make this an example per se, because it will be like I'll just be forcing it. I have to be realistic. I didn't trade on the second of. I'm not going to trade in the beginning of the first day of the year. Okay, so we can see price has respected that by just looking at structure. We can see price has left us with a change of character over here. So with that said, this is an internal change of character once again, meaning price over here at this level has formed a higher high, which means we can now expect bullish movement. So what do we see? We can see that over here is a demand zone. And notice this, what happened? So here is this box over here is our New York session. Chad, well, is it needed to go back to what the chart did like 2 weeks ago? If you truly want to understand the order flow, you have to go back and look at the order flow, because you can't just look at today's data and be like, okay, no, I know the order flow. You have to go and back it based on the data that the chart has showed you. So over here, you'll see this is the Asian low over here. Notice how price just tapped the Asian low in the demand zone, and that's how you had your move to the upside. So I wonder if I can go so far back in time. I'm going to see if I can real quick. I don't think. Oh no, I can't go that far back in time. Try again. Okay, yes, we can. Awesome. So let's look at structure here. So basically, just looking at structure, when price pinned below this level, so this was actually perfect. This was 4 o'clock. The only thing is not a time, but just follow structure, okay? Here we had change of character. So what did price do? Left us with a demand zone. What happens is we're now in a demand zone as well. So you want to always have a nice stop. Here you can see the stop is literally, this is 6 pips. So if you go with a normal 10 pip stop, you'd have been in the trade, take profit at that liquidity high, that wick. As you can see, perfect 1 to 3 risk to reward ratio. Take it further real quick. Let's just quickly see. I know we had some zones marked out over here as well. Notice the supply zone which we had over here. But then notice when it happened, when it tapped into it in Asian session. So notice what happened. Price broke through it, disrespected. This is why your timing and your session plays a very, very big role. So price disrespected that level. But then if we just look at internal structure, you will then see price has left us with so there is a break of structure, and here is the demand. So notice this over here, exactly in, let me go back to the 5-minute. So literally over here. Notice before price came into this demand zone, notice this. So actually, if I refine this, my 5-minute, Now you see a double bottom. So people bought early at this level. And what happens now is all you have to wait for is your change of character. So when price taps into the zone, okay, I can't go so far back now, basically, but yeah, just to give you an idea, change of character. There's obviously that take place on the 1 minute. So if I go back for you and if I go deep into it, this just comes with experience. So basically, when price has broken on a smaller time frame here, that would have been your change of character. Then your demand zone would have been some sort of, if I just put a fib from here till here, the OTE 705 lines up with this wick. So then that wick alone and using this lows can literally put in your trade there. And once again, like if you put, even if you put your stop below the level, that's 4.1 pips. Below the level, that is 5.7 pips. And what do? You just target liquidity basically. Now, also another thing, be mindful that this zone is now, oh damn, this zone is now, it's 65, 66 pips. So that is your Asian range blown out. So technically, in a case like that, you want to go 50%. Literally from there till there, 1 to 5. There's your trade out of it. And obviously, you can have another take profit at your highs, hoping that that will be taken out, and you see it, and you take it from there, basically. So let's just quickly take it further on that. Let's see what price does. We move forward in time. This was news that came out 3 o'clock. So this makes sense why price has moved down. But also notice what happened over here. So I don't know if you guys can see this little gray box over here. This was the low of New York. So this means the New York liquidity has just been swept. Literally, price just swept that low and moved to the upside. Now you can take it even further if you look at structure. If you look at, basically do it like this. So if you look at that move in price form the break of structure, this candle over here, consider your demand. So even so, could have taken that trade. So in a case like that, that is about, it's big, so 50%. So in a case like this would have been a different story. So this is the low, that's 10 pips. Now you have to also have to, like I said, it's different. You're gonna have to see in time, like how price moves. But just to give you an idea, just by following certain rules, like for instance, like if you follow a 15 pip stop, for instance, I know that's the rule most people use, targeting it like that. There's so many ways you can get into this trade just by looking at structure itself. Now, I quickly want to touch on this as well. I wouldn't have taken this trade just by just showing you guys structure itself. Now, here's the supply zone. Now, I want to show you guys something really interesting on this. Now, this was literally New York session. Okay, also this doesn't count because the timing was after 6, so that also doesn't count. But let's look at another example just real quick. Here we can see internal structure. If you go to the 5-minute, I would say the next day would be something to look at. Okay, now even so, yeah, the market was very choppy, so you're still technically bullish on it. So only when price has broken check character below that level, I would look for sells. So also, okay, obviously I'm not now analyzing the market, so it's a completely different story. And if you look at the pay I'm looking at as well, it has been in a range ever since the beginning of the year. So I didn't really have a lot of opportunity here so far, because you will see this is where the year started, this white line, and technically price has just been trading within the zone. So price has just been accumulating orders. So if you look at Wyckoff, AMD, accumulation, manipulation, distribution. So I'm bullish on on this moving forward. And then basically, up until when we get here, I will start looking for myself. But yeah, I've already been spending this. I've already been into this for an hour. Just also guys from your side, I know now at the end wasn't the best examples per se, and that's purely because it's not like, yeah, I didn't choose the best pair to actually make examples on. But you guys, I'm sure you guys get the idea as to what I'm looking for on my charts. Change of character, my entry model. I mean, I also repeat it over and over on the live streams. From your guys' side, any questions? How was the session? Do let me know. Your feedback means the world to me. If I don't have any feedback, I feel like I've done a bad job. So in the chat, just let me know what you guys have thought about the session and any questions you guys might have. Okay, awesome. Awesome, Keenan. Thank you, man. Okay, great. Great. This is why I said love you guys so much, man. Christopher says it's like it gets better. It's like it gets better with every session. Yeah, man. Like I said, there's so much gems I can still share with you guys, but I don't want to overwhelm you and get into the more advanced things before we can actually get there. Okay, let me actually drop the chat on here so everyone can see it. Okay, so GXNG, do I use ICT or SMT? I think you mean SMC or only technical analysis. So GXNG, here's the thing. I don't identify as an ICT trader or a retail trader or a scalper, intraday swing. I don't label myself as any of those things. Even yes, I use ICT concepts or smart money concepts, but also if you look at ICT and smart money concepts, it's the same things. For instance, a break of structure, a BOS, it's just a higher high or a lower low being formed. And if you look at smart money concepts, it's just what they call uh, a shift in market structure or a MSM or SMS, something like that. But it's the same concepts. So what I always tell people is you have to find, like, a lot of guys like that, they create these strategies and so forth just to sell it to you because it sounds cool. But like I said, a very, very simple break of structure on ICT or shift of market structure on smart money concepts is simply price forming a higher high or lower low. It's very, very simple. Okay, and then Jaden, how many pips does it need to be for the Asian session to be blown out? So this goes back to also, you have to consider not all pairs move the exact same amount of pips. So meaning if I compare a GBP pair compared to a Aussie pair, the Aussie pairs is much, much less volatile. So for instance, your Aussie pairs, so the ideal Asian range is 25 to 50 pips, but at least 25 pips minimum. If it's anything more than 50 pips, your box is blown out on any pair. But you would see the pairs that have the tightest Asian ranges, 25 pips and less. That's when you have the strongest moves that day. Okay, Earl's asking in my experience that does tracking quarterly data help my setups? Definitely, definitely. So all the same concept of how your highs and lows of the day, the week, the month, the year, the same concept for the quarters. We call that the quarters theory. We will also talk about that in the future once we get to that point. There's actually on my YouTube as well. I think the second video I uploaded 4 years ago. I spoke about the quarters theory. You guys can also go check it out. And Chadwell says, thanks, Jeff. You helped a lot. We'll watch it again later on YouTube. Awesome, man. And also, guys, make sure to like and subscribe and share it with other traders. I mean, it's free. Share with other people far and wide. Let's change the way this industry operates, man. Like diamonds in the sky. Okay, awesome. Christopher, bro, I'll keep on doing this for you guys. Nothing will ever stand in my way. But great, man. Glad you guys loved it. I'm glad you guys loved it. Let me end this recording. Let me edit it and get it out to YouTube so you guys can watch it again and take some more notes. And also, guys, those of you who are not under my mentorship program, please do message me if you do want to sign up. I will do something for you, a nice little discount. So if you want to do that, feel free to hit me up. And I'll see you guys next Monday for day 4.